Okay, let's now continue with the discussion. I started with inflation and capital budgeting. Let me quickly again do that. What is inflation and capital budgeting? Is the cash flows which are given can include inflation, can exclude inflation. So the approach is very simple. I have real cash flow. If you add inflation, it will become money cash flow. It will become money cash flow. And if you discount this, it will come discounted cash flow. There is a DCF, there's an RCF, and there is a MCF. DCF is discounted cash flow, which is the present value. Real cash flow is excluding inflation. Nominal cash flow is normal cash flow, which you see. This cash flow, if you discount at MDR, money discount rate, you will get the discounted cash flow. Money cash flow discounted at money discount rate will give you the discounted cash flow. Real cash flow discounted at real discount rate, discounted at RDR will give you the discounted cash flow, will give you the discounted cash flow. Somebody wants to move from MCF to RCF or RCF to MCF, you just need to add inflation or remove inflation. Add inflation or remove inflation. When I say add inflation, addition can be done. Removal is not minus, removal is division, because when you want to do any discounting, we don't do minus 10%, we do divided by 1 plus 10%. The present value factor is calculated as 1 divided by 1 plus 10%. For example, my real cash flow is 5,000. 10% is the inflation. Nominal cash flow is 5,000 plus 10%, 5,500. From 5,500, if you want to go to 5,000, divide by 1 plus the inflation. Divide by 1 plus the inflation. You cannot just that I want to do minus 10%. That will add inflation will work. Technically, I'm not adding also. Technically, I'm doing into 1 plus the inflation rate. Adding is technically into 1 plus the inflation rate. And when you want to go back, divided by 1 plus the inflation rate. One example around this, real revenue of year 2 is 10 lakh. Real revenue of year 2 is 10 lakh. Inflation of year 1 is 10%. Year 2 is 8%. What is the nominal revenue? What is the nominal revenue? So this is a year 2 calculation. For year 2 calculation, you have to give effect to first year inflation, then to second year inflation. Normally, you will have the same inflation. If you have the same inflation, you could have added into 1.1 power 2. But here the inflation is different. So what you need to do is 10 lakh doing calculator into 1.1. This is giving effect of first year inflation into 1.08. This is giving effect to the second year inflation, giving effect to the second year inflation. So you will have to give effect to not only first year inflation, also to the second year inflation. To cut it short, I have DCF, RCF, NCF. DCF to RCF, RDR, this inflation rate, and this is money discount rate. Money discount rate. From money cash flow, you want to come to discounted cash flow, do MDR. Now, how will this help us in when we do a question? Whenever we do a problem, we have to look for what is the cash flow given and what is the discount rate given. There are few questions where both are directly given. Then if both are directly given, if both are matching, that is both are real cash flow, discount, close it. Both are nominal cash flow, discount, close it. One is real, other one is nominal. You'll have to use the formula, do the conversion and then proceed. Converting the discount rate is easy. Converting the cash flow is difficult. But discount rate conversion can be done only when you have one inflation rate. Few question will say first year this inflation, second year this inflation, third year this inflation, fourth year. In that case, you cannot convert the discount rate. You will have to only convert the cash flow. You'll have to only convert the cash flow. Converting the discount rate is only possible if you give me one discount rate, one inflation rate, and then you tell me MDR. 1 plus MDR is equal to 1 plus RDR into 1 plus inflation rate. Like that you can do. Let's see questions on this. Come to 32. Sashi Company Limited has projected the following cash flow from project under evaluation. Year cash flow. Above cash flows have been made at expected prices after recognizing inflation. Expected prices after recognizing inflation means what are these cash flow? These are nominal cash flow or money cash flow. For nominal cash flow, you need nominal discount rate. You need nominal discount rate. What is the cost of capital given in the question? 10%. Cost of capital given in the question does not mean it is RDR, does not mean it is MDR, it is assumption. But now the problem is, if somebody says cash flow is MCF, discount rate is also MDR. If you take that assumption, the purpose of the question gets lost. The purpose of the question gets lost. ICI wouldn't give you the cash flow discount rate directly and then tell you just do discounting and give the answer. So I'm assuming the given cost of capital is RDR. If you assume as MDR and give the answer, ICI will not award marks. Let me make it very clear. It's assumption only. It's assumption only. But if you make MDR, year is there, cash flow is there, discount rate is there, then what are we going to do? We don't have anything to be done in the question. If everything is directly given just for the purpose of discounting, there cannot be a mark. So first thing you need to do is convert this 10% into MDR. Now write 1 plus, see, approx answer is 15%. 10 plus 5 is the approximate discount rate, but that will not help. 1 plus MDR is equal to 1 plus MDR is equal to 1 plus RDR into 1 plus inflation rate. 1 plus MDR is equal to 1 plus RDR into 1 plus inflation rate. What is the RDR given in the question? 0.1, 10%. Inflation 0.05. MDR is equal to 15.5%. MDR is equal to 15.5%. 1 plus MDR is equal to 1 plus RDR into 1 plus inflation rate. You get the answer as 15.5%. Clear? MDR, NDR is same. MCF, NCF is same. Money cash flow, nominal cash flow, normal cash flow. Money discount rate, normal discount rate, nominal discount rate. Real cash flow, real discount rate. So normal cash flow also normally means nominal only, because what you write in your balance sheet or P&L is only normal cash flow. You will not say I'll remove inflation and do it. Year cash flow PVF DCF. Year cash flow PVF DCF. Year cash flow PVF DCF. PVF at what rate? 15.5. Year 0, 1, 2 and 3. We will always prefer to adjust the discount rate rather than the cash flow. Cash flow is a complex process. I don't want to get into it, but some question we may have to do it when you have multiple inflation rates. Our question specifically tells you follow approach. What is the cash flow here? Year 0, negative 72. Year 1, 1 divided by 1.155. DCF. NPV is calculated. It's not very much about the NPV number, okay? Even if you don't get the number, I am not really bothered about it, because anyway it's readily available. I would have stopped with 15.5 itself just to give you the full experience. I've done the calculation. Otherwise, it doesn't serve any purpose. Okay. Assuming the same question, ICI says no, I don't want you to do it. You have to use only 10%. This you have to use real discount rate. You have to use real discount rate. Not needed for you to solve. Be in listen mode. First year 30,000. Remove inflation. Remove inflation. So 30,000 divided by, not minus, divided by 1.05. Divide by 1.05. Second year divided by 1.05 two times. Third year divided by 1.05 three times. This is converting the nominal into real. Real to nominal, you can add 5%, add 5%, add 5%. When you want to do the other way around, divide by 1.05. Now I need to discount this at 10%. I'll get exactly the same answer. Up and down rounding of difference can be there. Just give me a minute. Is there any error in any cash flow? Okay. 3401. 3401 is the answer, or 3450 is the answer. Approximately the same. That 50 rupees is rounding of difference. So you can follow the first approach which I said, which is easy to do. Second approach, if question specifically tells, go ahead and adjust the cash flow. Go ahead and adjust the cash flow. I don't have a choice. I don't have a choice. Any doubts on this? Can we proceed? Go through 33. Okay, listen. Initial outlay, no problem. Annual revenues without inflation. So revenues are real cash flow. Revenues are real cash flow, and cost of capital is including inflation, which is MDR, money discount rate. Two choices: either convert the MDR into RDR and proceed, or convert your cash flows into nominal cash flow. Convert the cash flows into nominal cash flow. That is, first year it's not 30,000. 30,000. What is the inflation rate? Plus 10% for first year, another plus 10% for second year, another plus 10% for third year, another plus 10% for the fourth year. Now ICI in this question, ICI in this question would have followed an approach of converting your cash flows. Last question they followed an approach of converting the discount rate. When to do, follow which doesn't really matter. Here we have converted the cash flows and got the answer. Alternatively, you can adjust the discount rate to RDR and compute NPV using real cash flows. The two approaches will give a slightly different answer here. Reason for that also I'll explain it. So that is why I always prefer MDR approach. Okay, wherever possible, try to do only MDR approach wherever possible. First question also, we calculated the money discount rate, did it. Where is the differences? This item will not change based on inflation. This item, depreciation, will not change based on inflation. So when you calculate your money discount, that is your this cash flow, nominal cash flow and real cash flow, when you do the calculation, there is a problem with this depreciation item. There's a problem with depreciation item which does not change with inflation, and this can sometimes lead to variation in answer. If you see here, what ICI did is they have calculated this and then added 10, 10, 10, 10. This is also technically has an error. What is the error is, this 15,000 for first year is fine. When I do real, this will be added by 10%. This will be added by 10%. But why should I add 10% to depreciation? Why should I add 10% to depreciation? If you don't add 10% to depreciation, your 15,000 will not become 16,500. 15,000 will not become 16,500 because you need to add 10% to everything. But okay, exam question, that's how they will do. They'll calculate one number, but always try to follow MCF approach wherever possible. Wherever possible, let's try to follow a money cash flow based approach. Alternatively, they have given in the answer. But money cash flow is the preferred approach. Go through 34. Okay. Question has given some data. They have mentioned, guys, please. 8 lakh for a new project, useful life, salvage value, depreciation charge, expected revenue and cost, ignoring inflation. Ignoring inflation means what? And if you say this is real discount rate, if you say no use of any of this, if you say this is RDR, If you say this is RDR, I have zero utility of the below information. I have zero utility of the below information because you have real cash flow, you have real discount rate. Go ahead and complete the question. Go ahead and complete the question. So I am assuming in this question cost of capital is MDR. First question I did, I assume cost of capital to be RDR. This is just to ensure that our solution don't become so simple, because here revenue is there, cost is there, deduct depreciation, get to the CFAT and do discounting at 10%. Then the zero utility of the revenue and cost inflation. Clear? Any doubts on this? So in this problem, my assumption is cost of capital given in the problem is money discount rate. Cost of capital given in the question is money discount rate. Somebody says, no, I want to take real discount rate. Then zero utility of the question. There is no utility of anything in the question, because you have made that assumption. You have the real cash flow. You get the answer. What are you going to do out of this? It's all. Everything is readily available. So here first we will understand how to calculate now money cash flow. Money cash flow, once that is calculated, discounting is at 10%. Discounting is at 10%. Also, assuming question clearly mentions that this is a money discount rate. Question clearly mentioned this is money discount rate. Then you cannot convert that into RDR, because I have multiple inflation rate. I have multiple inflation rate. Conversion is not possible. Assume question says this is RDR. Again, conversion is not possible. If this is RDR, go ahead. For example, the question says this is including inflation. Including inflation, and below they say this is real discount rate. Below they say this is real discount rate. Don't try to do anything with the discount rate. Though I say MCF is the preferred approach, I cannot do anything on the discount rate, because I have a different inflation for different year, different inflation for revenue, different inflation for cost. So in these type of question, only cash flows can be adjusted. Only cash flows can be adjusted. You cannot adjust your discount rate. Now, right, it is assumed the given discount rate is nominal discount rate. Computation of nominal cash flow. Computation of nominal cash flow. Particulars 4 years. Particulars in 4 years. We'll start with revenues. For the first year revenue, add inflation 6 lakh plus 10%. 6 lakh 60. Second year, when you do, first add 10%, then add 9%. First add 10%, then add 9%. You have to give effect to both inflation. You have to give effect to both. 7 lakh into 1.1 into 1.09. Do only 2 years, okay? Not the third and the fourth year. Third year, you have to give effect to 3 inflation. Fourth year, you have to give effect to first year inflation, second year inflation, third year inflation, and fourth year inflation. We'll restrict our calculation to 2 years. We'll restrict our calculation to 2 years. Any doubts on this? For third year, you'll have to first add first year inflation, then add second year inflation, then add the third year inflation. Less. What the cost given in the for first year? 3 lakh. What is the inflation? 336. Second year, 4 lakh plus 12 plus 10. 492, 800. Giving effect to first year inflation, second year inflation. Yes, depreciation. What's the depreciation number? No inflation, nothing can come here. Depreciation, nothing can come. That is where I said I have an issue with the last solution. I said I had an issue with the last solution because of this only. Depreciation 2 lakh. PBT less tax, PAT, add back depreciation, CFAT. PBT deduct tax, PAT, add back depreciation, CFAT. The tax rate 60%. You get PAT, add back depreciation. Like this, you can keep doing any number of years. Again, I'm repeating, if somebody says why I took one question RDR, one question MDR, understand the logic or the base behind it. If you take an assumption which makes the entire calculation so simple, ICI will not award marks. ICI is not going to award marks because you're removing the inflation from the question fully. You're removing the effect of inflation fully from the problem, which is not right. Any doubts on this? Like, hmm, hmm, will depreciation, that's what you tell me, will depreciation increase because of inflation? Tell me, go ahead. So to cut it short, I'll tell you, if inflation keeps going up, your value of tax benefit relating to depreciation will keep going down. Why does it go down? Because the depreciation tax benefit is a every year 2000 rupees, absolute amount is same. If inflation goes up, when you discount it, you will keep penalizing it more and more. You'll keep penalizing it more and more. So if inflation starts going up, there are certain items which move with inflation. I have no problem with those items. And there are certain items which cannot move with inflation. Example is depreciation. So indirectly, by writing same 2 lakh, I'm reducing my tax benefit. If this had gone up because of inflation, my tax benefit would have been more. My tax benefit would have been more. Income tax authorities are not going to allow you to say that increase the depreciation. So, in case this can be an MCQ, in case inflation is going up, what is the impact on depreciation tax benefit? Value of tax benefit of depreciation will go down. Value of tax benefit of depreciation will go down. Present value, today's value, because inflation is going up. When inflation goes up, you will start discounting it at a higher rate. You will start discounting this at a higher rate. So inflation has this problem. All other items will keep pace with inflation. Depreciation cannot keep pace. Okay, next part 7 of the chapter, which is on expected value, standard deviation, and coefficient of variation. Something which is done for few students at CA interlevel. For most of you, you would not have seen this, but very simple. Expected value is nothing but return, probability, product, deviation, PD square. Return is NPV. Return is NPV. NPV, probability, product, deviation, PD square. Sum of the product is called expected NPV. Sum of the product is called expected NPV. Square root of PD square is called standard deviation. Square root of PD square is called standard deviation. And coefficient of variation is risk per unit of return. That's the formula. Risk per unit of return. So risk is the numerator, standard deviation. Denominator is return, which is NPV. Denominator is the return, which is NPV. Expected value, NPV, is the weighted average of various possible value with probability being the assigned weight. Standard deviation is the expected deviation upward or downward from the expected value. Coefficient of variation is risk per unit of return. Format, NPV, probability, product, deviation, PD square. Few questions, instead of doing NPV, probability, product, we'll do cash flow, probability, product, deviation, PD square. When you do cash flow, you will get every year expected cash flow. Every year expected cash flow and every year standard deviation. Every year there are two types of question. One question where you have NPV is available. NPV, probability, product, deviation, PD square. This gives you expected NPV directly and standard deviation directly. Some question we will do cash flow, probability, product, deviation, PD square. When to do those things, I'll explain as we proceed. So that will give you expected cash flow and standard deviation of every year. What is the final NPV? NPV of the expected cash flows. That is year cash flow PV of DCF, year 0 outflow, year 1 expected cash flow, year 2 expected cash flow. Do an NPV of that. And standard deviation is the sum of year 1 standard deviation, year 2 standard deviation, year 3 standard deviation with discounting. Discounting being applied, you'll understand as we proceed. A project is likely to generate cash flow of 1 lakh, 20% probability, 50,000, 40% probability, and minus 25,000. Minus 25,000, 40% probability. How much is the standard deviation? Now listen, for doing standard deviation, this is asking for cash flow standard deviation. It can ask NPV standard deviation also. Our format is cash flow, probability, product, deviation, PD square. Don't write number as 1 lakh. If you write number as 1 lakh, deviation will be 10,000. Okay, 10,000 into 10,000 will run into so many zeros. 10,000 into 10,000 will run into so many zeros. So if they give 1 lakh, I'll do either in hundreds or thousands. So thousands or lakhs. So I'll write it as 100. I'll write the numbers as 100. If you write 1 lakh, no, this would have been 70,000. 70,000 into 70,000. Imagine the number 70,000 into 70,000. You will get stuck at that stage. You will get stuck at that stage. So we'll prefer to do the problem rather than writing the numbers. We'll either do it in thousands or lakhs or crores, because 70,000 into 70,000 into 0.2, you will get stuck. You can write it, but somewhere when you put a total, somewhere you'll end up making a mistake. Clear? Any doubts till this? I'll directly do a question on the problem. When I do a problem, we'll do a directly problem. Project A generates NPV of 10 lakh, standard deviation of 5 lakh. B has NPV of 14 lakh, standard deviation of 8 lakh. Which is better if coefficient of variation is used as a measure of risk? Now listen. One is NPV, which is liked by aggressive investor. Aggressive investor want return. Second is standard deviation, which is liked by conservative investor because you have risk return. So aggressive guy says, give me maximum NPV. Give me maximum NPV 14 lakh. 14 lakh. Conservative guys say, give me lower standard deviation. Give me lower standard deviation. When you club them together, that is called coefficient of variation. The formula is risk per unit of return. Risk per unit of return. So lower CV is better or higher CV is better? Risk per unit of return is the formula. So you want to take lower risk per unit of return or higher risk per unit of return? Lower. So project A 5 lakh by 10 lakh 0.5. Project B 8 lakh by 14 lakh would be some 0.57. So I will prefer project A. I'll prefer project A. We'll do problems on this. Then you do standard deviation. No? There are two types of cash flow. One is called dependent cash flow. Second is called independent cash flow. Now first let me explain what is dependent cash flow, what is independent cash flow. In my regular class video, I've discussed a detailed approach to do the calculation. I cannot do the detailed approach, but I'll explain some logic. Dependent cash flow means I'm starting a project. Project will run for 5 years. Okay. So let's assume Bharadwaj Institute is launching some new product which is going to be there for 5 years. First year, we did not get good response from students. If first year is a failure, second year failure, third year failure, fourth year failure, fifth year failure is called dependent. That is, if you start with a bad year, you will continue to get a bad year. And if you start with a good year, you will continue to get a good year. You will continue to get a good year. That is called dependent cash flow. That is called dependent cash flow. Most of the cash flow in practical world is dependent. For example, I'm opening a restaurant in the street. If first year there is a good response, high probability, unless I goof up in service and all, I will continue to do well. I'll continue to do well. And if first year I'm failing, high probability I'll continue to fail in future. Independent means first year super performance, second year bad performance, third year moderate performance, fourth year good. Independent means there is no linkage. First year bad, second year can be good, third year can be bad, fourth year can be good, fifth year can be good, sixth year can be bad. There is no linkage at all. That is called independent. Statistically, independent cash flow will have lower risk. Independent cash flow will have lower risk. Reason for that is, if you get a bad year, at least some hope is there that you may get a good year. Or if you get a good year, it can turn into bad year. That is, dependent means extreme good performance or extreme bad performance. You will either get an extreme good performance or you will get a extreme bad performance. That is dependent. When extreme happens, standard deviation will magnify. Standard deviation will magnify. When you have independent cash flow, good, bad, good, bad. So on an average, I may put up a decent performance. I may put up a decent performance on an average if I look at. So we have two types. Dependent cash flow carry inherent risk as a downturn in 1 year tend to lead to a series of consecutive adverse year. Tend to lead to a series of consecutive adverse year and vice versa. In contrast, independent is characterized by lower inherent risk. A subsequent cash flow are not contingent upon the performance of the preceding year. For example, you are going to write your AFM test. Let's assume 10 tests you are writing, full syllabus test. Mostly what you perform in the first exam will have effect on the second, third, fourth, fifth, because your understanding, your knowledge which is there in the first exam is known. More or less, if you are performing well, high probability I expect you to continue to perform well. But your performance in AFM cannot impact your performance in direct tax. That is independent scenario. That is two independent scenario. Whereas the same subject, if I look, it's a dependent scenario. Now, what we do in these type of question is, we cannot follow the earlier approach. If the question says dependent and independent, what is earlier approach is this? Calculating using this approach, NPV, probability, product, deviation and PD square. That approach will not work if the question says dependent and independent. In these type of question, you need to calculate every year cash flow, every year standard deviation, every year cash flow and every year standard deviation. So year standard deviation, PVF, discounted standard deviation. Year standard deviation, PVF, discounted standard deviation. Total of DSD, total of discounted standard deviation is one standard deviation. And in another approach, what you do is you square it. You square the standard deviation, put a total and then take a square root. Put a total and then take a square root. This will give a different answer. This will give a different answer. For example, 8 plus 8, 16. 8 square is 64. 64. What is the square root of 128? So 8 plus 8 is 16. 16 is one standard deviation. 8 square plus 8 square, 128. Square root 11 is another standard deviation depending on the type of cash flow. Depending on the type of cash flow. I said there are two types of cash flow. One is a dependent cash flow. Second is a independent cash flow. Which has more risk? So this is the answer for dependent, more risk. Square root of this is the answer for independent. Square root of this is the answer for independent, which carries what? Lesser risk. Which carries what? Lesser risk. Now, in class, I had shown an example where in year 1, 3 cash flows were there. Year 2, 3 cash flows were there. Year 3, 3 cash flows there. Independent means any combination can happen. Any combination can happen. So, in class, I calculated 27 different standard, 27 different NPV. That is first year good, second year bad, third year moderate. First year good, second year good, third year good. First year good, second year bad, third year bad. So any combination can happen in an independent. When I calculated the standard deviation of the 27 different NPV, I got this answer of square root of 128. Square root of 128. So basic thing is you cannot do 27 different NPV. If allowed a choice, see, if it's dependent, no, only 3 NPV. Why 3 NPV? All good, 1 NPV. All moderate, second NPV. All bad, third NPV. That is dependent. That is, in this 3, calculate standard deviation, you will get answer 16. You will get answer as 16. In independent, first good, second bad, third worst. Good, worst, bad. So any combination you can do, any combination. So doing so many NPV is not possible for you. That is where the shortcut comes into picture, which is year, standard deviation, PVF, DSD, DSD square, DSD square. Any doubts on this? You'll learn this in a problem. Now, some question will say something like this. A project has a life of 2 years. A project has a life of 2 years. Probability of the best cash flow is 30%. Best happening is 30%. What would be the probability of the best case NPV if cash flows are perfectly correlated and independent over time? Correlated and independent over time. I have 2 years. Year 1, year 2. If both year best happens, then only I'll get the best NPV. If both year best happens, then only I'll get the best NPV. So this is 30% chance. First year best happening is 30% chance. If it is dependent, second year best happening is 100%. if it is dependent, second year best happening is 100% because first year best has happened. First year best has happened. Independent means second year again 30% chance. Third year again 30%. Fourth year again 30%. That is when you toss a coin, first time you got heads. Second time will be head only. Third time will be heads only. Fourth time, if you say that, that is dependent. That is dependent. When you toss a coin, it is an independent scenario. It's an independent scenario. So if you need two times heads, your probability is 1 by 2 into 1 by 2. Your probability is 1 by 2 into 1 by 2. So for independent cash flow into power n, 30% power 2, 30% power 3 if it's 3 years, 30% power 4 if it's year. So in independent, worst happening or best happening is very rare. Worst happening or best happening is very rare. Whereas the other way around, first year 30%, that's all, that's the probability. No, because you'll do into 100 into 100 into 100. You'll see this in a problem later on. Let's see problem now. RADR I'll explain later. Come to 35. Come to 35, go through this. Go through question one quick. Okay. I'll focus only on project A. I'm not going to do project B. Company is having two mutually exclusive projects. Project A costs 36,000, project B 30,000. You need to calculate NPV of each project. Again, to me, this is like a useless question because in portfolio, I search for return and probability. Here I search for NPV and probability, which is directly given. NPV and probability is directly given. What you need to add? Product, deviation, and PD square. You just need to add extra 3 columns. You just need to add extra 3 column because NPV and probability is directly given. What am I required to do here? Only thing is we will not write 15,000, we'll write it as 15. If you write 15,000, squaring will lead to a lot of challenges. Working note 1, computation of NPV and standard deviation. NPV and standard deviation. Probability, sorry, NPV, probability, product, deviation. Basically format one of portfolio management. You will keep using that only. Format one of portfolio management. There it was return probability, here it's NPV probability. In the right hand side corner in thousands. In thousands. Only first project we will do. First question, we'll do it together fully properly. Next question onwards, if a lot of calculation is there, I will do it. The explanation part will be the most critical. What are the NPVs given? 15, 12, 6 and 3. Probability is product, do the multiplication. Do it. I want you to do one question. Expected NPV 9,000. Standard deviation, take a square root first and then do into 1000. Take a square root first and then do into 1000. Don't do into 1000 without taking a square root. Some students did that in exam. Don't take a square root, sorry, don't do into 1000, because PD square not is into 1000, it has to be 2 times into 1000. So 19.8, take a square root first, leave the number in your calculator and do into 1000. 4450 is the standard deviation. 19.8 square root and into 1000. 4.4497, 4.4497 into 1000, if I do 4449.7, which is rounded off to 4450. 4450. 19.8 square root into 1000. Any doubts on this? Clear? Can you proceed? The question has also asked for profitability index. PI is equal to, profitability index is equal to, any doubts on this first? First question I want you to be fully clear, because I may not give time later on. If there's a doubt, let me know. PV of inflow divided by PV of outflow. Inflow is NPV plus outflow. I had told you this when I was doing the initial explanation. In the beginning, in the morning session, I told you inflow is nothing but NPV plus the outflow. NPV plus the outflow. 9,000. What is the outflow given in the question for project A? Divided by 36,000. 9,000 plus 36,000 divided by 36,000. 1.25. Any doubts? Clear? They ask for expected NPV, risk profitability index. Which one do you recommend? Higher return. Listen, higher return, lower risk. In case there is no domination, which can happen sometimes, then you will say aggressive guy will select this project, conservative guy will select some other project. If one project has more return, another project has less risk. Okay, you are now going to do this. You will be in listen mode. A Limited is considering two mutually exclusive projects X and Y. You have been given the following net cash flow of the probability distribution of each project. Project net cash flow and probability. Again, I have all the data which is needed. They are doing only cash flow, no NPV, nothing is asked in the question. Because for doing NPV, I need outflow, first year inflow, second year inflow, third year. What they asked, expected net cash flow. Expected net cash flow is the weighted average of the various possible cash flow, with probability being the assigned weight, variance, standard deviation, coefficient of variation. I'm going to discuss each of them. I'll first put the data. 50, 60, 70. What's the probability given? 0.3, 0.3. So my answer is expected cash flow is 61,000. Expected cash flow is 61,000. Variance is 69 into 1000 into 1000. Variance is 69 into 1000 into 1000. If at all they're asking me to write variance, it is not 69 into 1000. Variance is 69 into 1000 into 1000, because we have done it in thousands. If I don't do this problem in thousands, which Excel I have no problem, 50,000, 60,000, 70,000. Excel I have no problem, I'll get the answer like this. In Excel I have no problem, I can get the answer. But when I tell you to work with these numbers, so many zeros, most of the time student will end up making a mistake. So for that purpose, we made it as 50, 60, 70. So variance is not 69 into 1000. Variance is 69 into 1000 into 1000. Standard deviation is square root of 69 into only 1000, into only 1 time 1000. because in square root 2 times 1000 will get cancelled. 2 times 1000 will get cancelled. Tell me the formula for coefficient of variation. Standard deviation, which is 8307 divided by 61,000. 8307 divided by risk per unit of return. Risk is standard deviation, return is product. Return is product total or expected cash flow total here. Any doubts on this? Can you please tell me which is better project between the two? Nothing much for you to read. Tell me which is the better project here. Yeah, first thing is I will not get into coefficient of variation. Coefficient of variation is second part of the question. Coefficient of variation is second part of the question. If you are a guy who's aggressive investor, aggressive is you want return. Which project will you select if you want return? Why? Which project will you return if you want low risk? So both are right in their view. Okay, you cannot tell them that he is wrong or you are wrong. Aggressive guy will select project Y, conservative guy will select project X. Coefficient of variation forces people to select only one. No conservative, no aggressive. No conservative, no aggressive. So 90,000 divided by 122 is the coefficient of variation of first project. 90.74 decimal, will keep it 7377. Second one is 120 divided by 225.5333, which is better? Y. Project Y. So even a conservative guy, if he comes, I will tell him you select only project Y, but he may not accept it. He may not accept it, but I am going to tell him that you have to do this. A conservative investor would focus on reducing the risk, aggressive would focus on increasing the return. NPV method in such conflicting situation is best because it is in compatibility with wealth maximization. This is added in ICI material. You can just write as it is in case it comes in exam, because different people have different expectation. See, you cannot say NPV is always the best. I will say I don't want to get into NPV. I want lower risk. I want lower risk. So when I want lower risk, you cannot force me. You cannot force me. So if you're forcing me, okay, I'll agree with whatever you're saying. But my expectation is very simple. I am a guy who's a conservative investor. I want to reduce risk. This is part 3 of the word solution is exactly ICI wording, where they've said in case there is a conflict and all, you go by NPV method of wealth maximization. Go through 38. Okay, all datas are there in front of you. Let's first decide the approach and then I do calculation. You're not going to do calculation. I know when I'll tell you to do calculation, some part of the calculation you're not going to do, some part you will do in this question. Jet Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakh. Expected cash flow, CFAT, probability, year 1, year 2 and year 3. Company wishes to take into consideration all possible risk factor. Expected NPV assuming 6% risk-free rate of interest. They've asked for NPV. Now when you want to calculate NPV, two approaches are there. One approach is NPV is equal to weighted average of the various possible NPV with probability being the assigned weight. That's first approach. Second approach is NPV is the NPV of the expected cash flow of the project. NPV is the NPV of the expected cash flow of the project. Both will give same answer. If you want to do weighted average of various possible NPV, it is not possible for you to do. Reason is first NPV is this, This is one NPV. Second NPV is this, and this one. Third NPV is year 1 same, year 2 same, but this one. Like this, you will have 64 different NPV. Like this, you will get 64 different NPV, because year 1 can be 14, year 2 can be 15, year 3 can be 18. Year 1 can be 14, year 2 can be 15, year 3 can be 25. 4 into 4 into 4, 64 different NPV will be there. Kind of impossible for you to do. So in this question, every year I'll calculate expected cash flow. Every year I'll calculate expected cash flow. I'll convert all the 4 into single number. All the 4 into single number. All the 4 into single number. When I do this, I'll also calculate standard deviation every year. I'll also calculate standard deviation every year. Why I'm doing standard deviation? Because anyway I cannot do 64 NPV. I cannot do 64 NPV. Another reason for doing standard deviation every year is question has said independent and dependent. Independent and dependent. For independent and dependent, first I need base numbers. So what I am going to do is in Excel, I'll first show you first year expected cash flow, first year standard deviation. Second year expected cash flow, second year standard deviation. Third year expected cash flow, third year. Beyond that, when I move to the next step, move to the next step, what is the next step I'm going to do? I am going to get into calculating the standard deviation or the expected NPV. In that step, we will do it together. We'll do it together. So first year, what is the cash flow? Tell me the cash flow. 14, 18, 25, 40. What's the probability? 0.1, 0.3. This is the answer. My expected cash flow is 27 lakh. Standard deviation is 9.24 lakh. I leave it as lakhs itself. I'm not converting into normal number. I'm not converting this into normal number. So first year 27 and 9.24. Second year 29.3 and 9.93. Third year 27.9 and 8.62. Assuming you get till this. Assuming you get till this. Because this is the first part of the calculation. Now start along with me. Computation of expected NPV. Computation of expected NPV. Computation of expected NPV. Year cash flow. PVF at 6%. DCF. If you calculate 64 different NPV and then do a weighted average, same answer you will get. Same answer you will get. 64 is not possible at your end. 3 years. We'll do it in lakhs only. We'll do the problem in lakhs only. What is the year 0 cash flow? Negative 50. First year is 27, 29.3 and 27.9. These are the numbers. Negative 50, 27, 29.3 and 27.9. PVF at 6%. And DCF. $24.98 lakhs is the NPV. 24.98 lakh is the NPV. Same will be the answer if you take 64 different NPV and then do a weighted average. Clear? Can you proceed? Next, computation of standard deviation. Same thing. Year SD. Year SD. PVF. DSD. Discounted standard deviation. DSD square. Year standard deviation. PVF at 6%. Discounted standard deviation. Please write discounted standard deviation square. One question in each of the approach. I'll explain. Balance, most of it will be in the Excel only. Year, standard deviation, PVF at 6%, discounted standard deviation, DSD square. 3 years. First year was the standard deviation we had 9.24. Second year was 9. Third year is, what is standard deviation? Is sum of the three, but with discounting. With discounting. So do PVF at 6%. PVF at 6%. DSD square. The total. The total and put a total and a square root. Complete this, I'll wait. One is total of DSD, another one is total of DSD square and a square root. In this 24 lakh, which is the higher number, is the dependent standard deviation, that is SD. If cash flows are dependent or correlated, 24.79 lakhs. SD if cash flows are independent or not related, 14.368 lakhs. Independent is low risk, dependent is high risk. Independent carries lesser risk, dependent carries more risk. Any doubts on this? Can you proceed? Any doubts on this? Done? So, in your notebook, just write this alone. SD and NPV. Approach 1, approach 2. Calculate NPV of each scenario and do weighted average. Calculate NPV of each scenario and do weighted average. NPV of each scenario and do weighted average. Can give best case, worst case NPV. Can give best case, worst case NPV. What is this? You will understand later. Can give best case, worst case NPV. If you give me 5 scenario, I'll calculate NPV for all the 5. I'll calculate NPV for all the 5. Cannot give two different standard deviation. Cannot give two different standard deviation. Cannot give two different standard deviation. That is, you cannot tell me, give me an answer for SD if cash flow is dependent and SD if cash flow is independent. This approach cannot give me that. It can only give me one standard deviation, but this can give me something called as best case NPV, worst case NPV. What is the utility of this? You'll understand. Second approach, calculate expected cash flow and SD of each year. Expected cash flow and standard deviation of each year. standard deviation of each year. Expected NPV is equal to NPV based on expected cash flow. NPV based on expected cash flow. NPV based on expected cash flow. SD equal to sum of DSD or square root of DSD square. You know which under which approach. Sum of DSD or square root of DSD square. You can just write this is dependent, this is independent. Dependent and independent. Cannot give worst case best case NPV. Cannot give worst case best case NPV. Cannot give worst case best case NPV. I'll simplify and explain again. See, few question will ask you to calculate two different standard deviation. Please, you have to follow only approach 2. Some question will ask worst case and best case NPV. You have to follow only approach 1. Some question have unfortunately asked both. You have to do both the approaches to get to the independent answers, which has not come in exam. Never it has come in exam. So to simplify, if I need, let's assume expected NPV. Question is asking expected NPV. Approach 1, approach 2, okay, both will give you the answer. Both will give you the answer. Single standard deviation. They did not mention which approach. No dependent, no independent. Only one standard deviation they are asking. Okay, both will give you the answer. Both will give you the answer. They don't mention that dependent cash flow, independent cash flow. Nothing is mentioned. They just ask standard deviation. The first problem we did, it just asked standard deviation. I did not tell you to do anything extra. It asks you best case, worst case. Okay, not okay. This cannot give me. What is best case and worst cases? You have to tell me 10 different NPV. In that, what is the highest is called best case, what is the lowest is called worst case. When I do approach 2, I don't calculate 10 different NPV. I don't calculate 10 different NPV. So how do I answer which is best case and which is worst case? Dependent and independent SD. Not okay. Okay. So till this, I have no problem. If only these are asked, your wish, you follow approach 1, approach 2, do whatever you want to do. You're comfortable with approach 1, do approach 1. You're comfortable with approach 2, do approach 2. Doesn't really matter. One thing I can tell you is approach 1 will not be possible if I have many scenarios like 4 into 4 into 4, 64 not possible. 4 into 4 into 4. So this question, best case and worst case, I have shortcut. I'll explain all that later. But 4 into 4 into 4, 64 is kind of impossible for a person to do. So approach 1 has its limitation. Approach 2 has one limitation, which is it cannot give me the best case NPV and worst case NPV, for which there are certain shortcuts available. Any doubts on this? Just give me a minute. Okay, let's look at this. Cyber companies considering two mutually exclusive project. Guys, investment outlays 5 lakh, has a life of 5 years. Under 3 possible situation, their annual cash flow is good, normal, worse. Cost of capital is 7%. Which project should be accepted? Explain with working. See, whenever exam question comes like this, don't stop at NPV itself. Just don't stop at NPV itself. If they give probability data, they're expecting you to answer standard deviation also. They're expecting you to answer standard deviation also. You have both approaches which are possible here. What is first approach is calculate 3 different NPV. Calculate 3 different NPV. How will I calculate 3 different NPV? 5 lakh is my initial outflow. 6 lakh is the inflow for all the 5 years. 6 lakh is the inflow for all the 5 years. 4 lakh is the inflow for all the 5 years. 2 lakh is the inflow for all the 5 years, or you take a weighted average. You take a weighted average. When you do weighted average, you'll be doing probability, cash flow, product, deviation, PD square. So when you do that, you will get the standard deviation for year 1. Same is the standard deviation for year 2. Same is the standard deviation for year 3. Same is the standard deviation for year 4. Same is the standard deviation for year 5. I normally prefer doing approach 2, but that has sometimes limitation. So here if you see, expected cash flow we calculated, standard deviation we calculated. NPV 5 lakh, using 4 lakh I have calculated. Standard deviation year 1, year 2, year 3, year 4, year 5. This is if you are dependent. Another one if you are independent. I'm answering both. I'm answering both. Now final conclusion to give, I need to check which is better from a return point of view, which is better from a risk point of view. Sometimes what can happen is both give same return, but one carry lesser risk, which is this example. One situation what can happen is one is higher return, another one is lower risk. Then you give about the answer saying that aggressive this, conservative this. Able to understand this? Any doubts on this question? Go through 40 and tell me the approach of solving this 40. Read the requirement, everything, and then tell me the approach. Read it carefully. Let me know which approach you want me to do. Go through this question and tell me the approach, please. Approach 1, approach 2, and how are we going to do it? You tell me the approach, then I'll show you the solving. I want to show the full solving part also. First, you tell me the approach.
Sir, approach 2.
Okay, I've got one answer from live online student. Approach 2, technically both are possible. Technically both are possible. In approach 1, you will have to calculate 5 different NPV. What is 5 different NPV? Initial outflow 80 lakh, every year inflow 11 lakh. Second, every year inflow 13 lakh. Every year inflow 15. How many years is this project? This is, where is it mentioned? Is the number of
Life
years?
has indefinite life.
They have
They
not
are
mentioned the
telling that
life.
they have the same life, but they are not telling what life
Okay,
it is.
so then there is no NPV calculation itself. Sorry, then there is no NPV calculation itself. They've asked only for standard deviation, variance, and coefficient of variance. So I'll go back to this table only. That's all. Cash flow, probability, product, deviation, and PD square. They've not even asked the NPV. They've not even asked the NPV. What is the cash flow they've asked given in the question? Give me the answers. 11, 13, 15, 17, 19. Probability. The total of this is called expected cash flow. The square root of this is called standard deviation. The square root of this is called standard deviation. Standard deviation divided by the expected cash flow. This is similar to this question we discussed. It is similar to this question. They have just given the cash flow and probability. They have just given the cash flow and probability. No NPV calculation. Nothing needs to be done in this problem. Go through 41. Let's discuss project. Then you cannot do. That possibility you take 5 into 5 into 5, 125. That you will not be able to do. Then do approach 2. Normally it is dependent in nature. Normally it is dependent in nature. Okay, ठीक है. I'll keep it this way. Let's not think that there are two approaches. Let's just think there is only one approach, which is approach two. Only one scenario you will do approach one, which is if they ask you best case and worst case NPV. If they ask you best case and worst case NPV, start 41. I want you to do. Please start doing 41 project X. I want you to experience it. Please start doing 41 project X. Approach to start doing it. Only project X. Yeah, only project X. Let's just think there is only one approach, approach two. Just 1 minute, I'll summarize what is approach two is. Every year you will calculate cash flow standard deviation. First year you will calculate, second year you will calculate, third year you will calculate. For example, if you were to do project Y, first year you will calculate, same is for second year, same is for third year. In project Y, same number for year 2 and year 3. Once you do that, based on expected cash flow, you get one NPV, and one based on standard deviation, you get two standard deviation, DSD and DSD square. Start doing it. Start doing it. Let's just keep it as approach 2. Please start doing it. Okay, I want you to do it. Only thing is, do the problem in lakhs, thousands, whatever number they give. Don't write it as normal numbers. Please take your time. First year expected cash flow 48.5 lakh, standard deviation 13.61. Do second year, do third year, and then do expected NPV and SD if dependent, SD if independent. Time consuming, but I want you to practice one question. Year 2 41.5, 9.76. Year 3 38.5 and 5.94. Will consistently follow approach 2 only in most of the questions. Rarely I'll get into approach 1. Till now only one problem we did approach 1 because the NPV was directly given in that question. The first problem we did, that was approach 1. Take your time. I want you to do one question so that you get grip on the approach. Your NPV two answers are there. Sorry, standard deviation two answers. What happened here? Oh, sorry. Figure 15.43. I would suggest you to at least practice one or two questions. Be clear on the approach too. Approach 1 we have just followed in one question till now, and in that problem NPV and probability were directly given. NPV and probability were directly given, and approach 1 as such is a more time consuming one. But yes, I'll still be using approach 1 in one more problem. I'll explain that. Any doubts on this? Can we proceed? Done. Take your time, take your time. One caution you need to take care is, for example, when you do project Y, you will do calculation only once. Same amount will be repeated in year 2, same amount will be repeated in year 3. When you do NPV, you can use annuity factor. But when you do standard deviation, unfortunately, you cannot use annuity factor because you need to square this. You need to square this. For DSD purpose alone, annuity factor can be used. But for DSD square, annuity factor cannot be used. So that caution you need to take care. So certain projects, they will not give data for every year. Only once they have given, more easy for me. I'll just calculate only once and copy the same number again and again. Can you proceed? Okay. I think now onwards, I think more of only listening part. So let's come to 42. Following are the estimates of the net cash flow and probability of a new project of ABC Limited. Be in listen mode. Initial investment 4 lakh. Inflow can be 1 lakh, 110 or 120. Salvage value can be 20, 50 and 60. Cash flows are directly given. Expected NPV, best case and worst case NPV. Best case and worst case NPV. If you want only expected NPV, what you can do is every year expected cash flow. Year 1 same, year 2 same, year 3 same, year 4 same. Year 5 will be a different one because year 5 salvage also needs to be added. Year 5 salvage also needs to be added. So you will end up getting first year expected cash flow, second year expected cash flow, third year expected cash flow, fourth year expected cash flow, fifth year expected cash flow. First year standard deviation, second year standard deviation, third year standard deviation, 4. 1, 2, 3, 4 in one working note itself, and 5 in a separate working note because there is a salvage value. Using the expected cash flow, you can get the expected NPV. But the second one is where the problem. The problem is best case and worst case NPV. So in this question, I'll first use this and calculate one NPV. Then I'll use the second data. I'll calculate one more NPV. Then I'll use the third data, calculate one more NPV, which is negative 8480. Second NPV is 48,060. Third one is 92,180. The probability for the first one is 0.3, 0.5, 0.2. Now, moment you get at this stage, it is exactly this problem where NPV and probability is given. It becomes this problem where NPV and probability are given. The background of this 35 is the question which you are doing now, where they have not given the NPV. They have not given the NPV, but they gave you the cash flow. They gave you the cash flow. What you will do now? NPV is there, probability is there. Attach a product column, attach a deviation column, attach a PD square column. That will give you standard deviation. That will give you standard deviation. Can I do approach 2? If you do approach to 1, it will take you more time in this question. And second challenge is I cannot get the best case and worst case. I cannot get the best case and worst case NPV. Any doubts till this? So let's look at the requirements now. This computation I'm not explaining. 8480, 48,060, 90 to 180 is very simple for you. Best case NPV, which is the highest of this? That is the best case NPV. Worst case NPV, negative 8480. Expected NPV is negative 8480 into 0.3 plus 48,000 into 0.5 plus 92 into zero point 0.2. You will get the answer. You will get the answer. Probability of the worst. Probability of the worst. If the cash flows are dependent and independent, worst is basically 0.3. Worst is basically 0.3. If it's dependent, listen, I toss a coin. First time getting a heads is 0.3 chance. Next time it will only be heads only. If heads come, it will only continue to be heads. So in 5 years, if this has to happen, 0.3 into 1 into 1 into 1 into 1. That is 0.3 is the first year probability. Second year probability is 1 time. Third year probability is 1 time. Fourth year probability is 1 time. Fifth year probability is 1 time. Why this one? Because dependent means worst will continue to be followed by the worst cash flow. Independent means first year 0.3, second year 0.3, third year 0.3, fourth year 0.3, fifth year 0.3. First year 0.3, second year 0.3. Can you tell me the multiplication of all of this and what number you get? It's a very rare scenario. In independent, it will be a very rare scenario. Which is like 0.243 percentage into 100 if you do. So there is a 30% chance of getting the worst in case of independent, and there's only a 0.243% chance of getting the worst in case of independent. Independent is you toss a coin 5 times if you need heads, 1 by 2 into 1 by 2 into 1 by 2 into 1 by 2 into 1 by 2, which is 1 by 32. Very rare scenario. Very rare scenario. Same way it is going to happen here. Then they're saying standard deviation and correlation of coefficient of variation. Standard deviation if you want, NPV, probability, product, deviation, PD square. No two separate standard deviation rule. No two separate standard deviation. They have not told standard deviation of dependent, independent. Nothing is there in the standard deviation part. If they ask that, we are gone because I have to go to approach 2. I have to go to approach 2. Last part says my normal coefficient of variation is in the range of 0.95 to 1. In this question, the coefficient of variation when you do calculation will be lesser than this. If it is lesser, 100 basis points are deducted from the cost of capital. What is the cost of capital today? 10. 100 basis point is 1%. So 10 will become 9. Again, you have to calculate 3 different NPV at 9% and then calculate the expected NPV. Again, you'll have to repeat the calculation at 9%. That's the last part of the question. That's the last. In this question, approach 2 will not help because you cannot get best case and worst case NPV through your approach 2. Clear? Able to understand this? Any doubts in the difference between approach 1 and 2? Can you please go ahead and calculate best case NPV? I want you to calculate only the best case NPV. You will surely make a mistake. Please calculate best case NPV. Only the best case. Don't look at the solution even one word, okay? Else that mistake will not happen from your side. Start doing the best case NPV alone. No NPV, no probability, nothing is there. Just the best case NPV. Determine NPV of worst case, base case and best case. Give me the best case NPV alone. That's all. Okay, I don't even want NPV. Just get me the cash flow, CF80. Just the CF80. That's all. Not even NPV. Just get me the CF80. Best case CF80. Do calculation, just not the calculator work. Start writing it. Revenues less cost, less variable cost, less fixed cost, less depreciation, PBT, do all that.
So is it 10 lakh 26 250?
Let others complete. I have no idea. I'll have to check. What's the number? Okay. One answer I've got is 10, 26, 250. Others, I want you to do it, please. Cash flow, correct. I just want the cash flow. I don't want the NPV and all. What is the revenue you have taken? Guys, all participate now. Revenues is what? 11,000 into 220.
225.
Variable cost?
100.
11,000 into what?
11,000 into 100.
Okay. Yeah, you are right. Best case is this, and this. This is the best case. Best case is lowest cost and highest revenue. Lowest cost and highest revenue. Students in exam just directly took this as the best case, this is the worst case. If the variable cost is higher, that does not mean that's the best case. Variable cost is, so that's why I wanted you to do it. I wanted you to do it only for this purpose. I don't have anything else to explain in the question. So the variable cost will be 100 rupees. Lowest variable cost. Lowest variable cost and lowest fixed cost. Lowest variable cost and lowest fixed cost. What many students did is they just took the upper estimate, they just took the lower estimate. The heading is upper and lower, the heading is not best and worst. Base I don't have a problem. The heading is lower estimate and upper estimate and not best case and worst case. So best case is highest units, highest selling price, lowest variable cost, lowest fixed cost, and as I think people said 10, 26, 250. 10, 26, 250. Beyond that, it's more of a formality. Beyond is more of a formality. Okay, this question also they have asked for best case and worst case NPV. Best case and worst case NPV, you will have to do three different NPV. Best case and worst case NPV, always you will have to do three different or four different NPV and then do a weighted average. I'll just summarize it before I take a break. I'll just summarize this part of it. Listen, first type of a question is where they give you the NPV and probability, where you need to do NPV, probability, product, deviation, PD square. Second, they give you cash flow and ask you best case and worst case. Ask you best case and worst case. You first convert the given data into NPV and probability. Convert the given data into NPV and probability by computing 3, 4, 5, whatever number of NPV. Mostly 3 or 4 will be there. Mostly 3 or 4 will be there. So you complete those NPV calculation. Then you do NPV, probability, product, deviation, PD square. Once you do this, the sum of the product is the expected NPV. Square root of PD square is the standard deviation. Standard deviation divided by NPV is called as the coefficient of variation. Some question will not even get into NPV. They'll just give cash flow. They'll just give cash flow. Sum of the product is called expected cash flow. Square root of PD square is called standard deviation, and expected cash flow, standard deviation divided by expected cash flow is called coefficient of variation. This is one type of a question. Then comes the second type of the question, which is what the major chunk of the question is going to be, where they give you cash flow. They don't ask for best case and worst case. Only situation, they don't ask for best case and worst case. If they don't ask for best case and worst case, if they don't ask for best case and worst case, first is calculate expected cash flow and standard deviation of every year. How you do? Cash flow, probability, product, deviation, PD square. Once you do it for 1 year, if the same is there for the second year, don't repeat it. That's the there for second year. Some question, same will be there for all the 5 years. Same will be there for all the 5 years. Then you have to calculate NPV. For NPV, you can do year cash flow PV of DCF. You can do 1 to 5 annuity factor. You can do 1 to 5 annuity factor. Then standard deviation, 1 separately, 2 separately, 3 separately, 4 separately, 5 separately. Discounted standard deviation and discounted standard deviation square. Discounted standard deviation and discounted standard deviation square. Total of discounted standard deviation is the SD if cash flows are dependent. Is the SD if cash flows are dependent, and discounted standard deviation square root, total square root is called as the SD if cash flows are independent. And some question will say, what is the probability of independent in cash flow and probability of dependent? Dependent is equal to first year probability. Independent is equal to first year probability power the number of years. Power the number of years. Clear? Any doubts on this? Let's take a break. We'll resume at 5. Okay. Okay. I'll now move to the next segment, 6 or 6:30, mostly to complete this. Okay, I'll move to the next segment, which is the easiest of the lot, called as RADR and CEF approach. I think among the various items in this chapter, RADR and CEF is the easiest of the lot. Let me first explain what is RADR and CEF. RADR basically, guys, RADR basically says the discount rate which we use cannot be same for all projects. If you have a certain project which is more risky, then you will have to use a higher discount rate, and less risky, you will have to use a lower discount rate. Not sure why this came as a separate approach, because normally our analysis is in this manner only. That is, if you have a risky project, you have a higher discount rate, and if you have a lower risk project, you have a lower discount rate. But RADR makes it very explicit. So a question will give you cost of capital, but you cannot use that as the discount rate for all the projects. You will have to use different discount rate. How can I do this different discount rate? I saw one exam question where they gave standard deviation and they mapped a standard deviation to a discount rate. Higher standard deviation, higher discount rate, lower standard deviation, lower discount rate. In one exam, they mapped with coefficient of variation, saying that something like this. Based on your coefficient of variation, the discount rate will change. If your coefficient of variation is 0.4, you follow 12% discount rate. If it's 1.2, follow 16% discount rate. If it's more than 2, follow 25% discount rate. So this is also one approach we saw. And in one exam scenario, they went ahead and said, do RF plus beta into RM minus RF. What is RF is the risk-free rate, but they did not have beta. Beta was called as risk index. Beta was called as risk index, and RM was called as normal cost of capital. RM was called as normal cost of capital. RADR operates on the principle applying a higher discount rate to risky projects, lower discount rate to low risk projects. So if you carry lower risk, the discount rate is determined on the basis by adding the risk-free rate to the risk premium. How can you build the connection? You can build the connection using standard deviation, coefficient of variation, or a risk index. Risk index is like beta. RF plus risk index into normal cost of capital minus the risk-free rate. RF plus beta into RM minus RF. Example, risk index of a project is 2 times. Risk index of a project is 2 times. Normal return I need is 15. So RF 10 plus 2 into 15 minus 10 is the RADR. 10 plus 2 into 15 minus 10 is the RADR. Now, once the RADR is calculated, you have your cash flows either given in the question, and if not given, then you have to follow the basics of your capital budgeting and calculate the cash flow and then do NPV. Only rule is NPV cannot be same. When you analyze two projects, normally you use same NPV, same discount rate. You use same discount rate. Here you cannot use same discount rate. One project at 10%, another at 15, another at 20. That is what RADR says. Then came CEF approach, which is slightly difficult for an organization to follow, but it is a better approach than RADR, but difficult to follow. What RADR says is the risk of a project is going to be same across years. When I say across years, year 1 20%, year 2 20%, year 3 20%. CF approach allows us to not change the discount rate. Discount rate under CF approach is equal to risk-free rate. Discount rate under CF approach is equal to risk-free rate. Then what does CF says? I ask the company, what is the cash flow we are going to generate in year 1? Company says 2 lakh rupees. Then ask, how confident are you? He says 90% confident. That 90% is called CF. That 90% is called CF. Moment you tell 90% confident, I don't write 2 lakh. I write only 1 lakh 80 as cash flow. I write only 1 lakh 80 as cash flow. So I reduce the cash flow itself. I reduce the cash flow itself. So I remove the risk from the cash flow. I remove the risk from the cash flow. So then you cannot separately discount it at risky rate. You cannot separately discount it at risky rate. So what you do is 2 lakh into uncertain cash flow into the CF is equal to certain cash flow. Uncertain cash flow into the certainty equivalent factor is certain. Certain means 100% likely to happen. 2 lakh you told, 90% chance, at least 1 lakh 80 will happen. At least 1 lakh 80 will happen. Convert uncertain into certain. Certain cash flow is equal to uncertain cash flow into certainty equivalent factor. The appropriate discount rate is risk-free rate. The appropriate discount rate is risk-free rate. Now, one exam question, they wanted to establish a link between CEF and RADR. The link is very simple. They told you do CF, completed everything done. Then they wanted to know if you apply RADR approach. If you apply RADR approach, which one should have higher RADR, which one should have lower RADR. That is no linkage with the NPV which you calculate. Some students thought if you get higher NPV, it means low risk and lower NPV means high risk. No. I have a project whose certainty equivalent factor is 0.8, 0.7. According to you, which is more risky in this? B is more risky. Lower CF, more risk, more RADR. Lower CF, more risk, more RADR. So which will be discounted at higher RADR? Project B. Project B will be discounted at higher RADR. Certain cash flow is 2 lakh. What is certain cash flow is? With 100% confidence. With 100% confidence. Certainty equivalent factor is 0.8. They are asking what is uncertain. The calculation is uncertain into 0.8 is certain. Uncertain into 0.8 is certain. So if certain is 2 lakh, uncertain is 2 lakh divided by 0.8. 2 lakh. I just tested this in MCQ. Exam question, they'll give you uncertain only. You need to multiply with the CEF and make it certain. Make it certain. Extremely simple questions. We will discuss few, we'll solve few. An enterprise is investing 100 lakhs in a project. Risk-free rate of return is 7%. Risk premium is 7%. Risk-free rate is 7. Risk premium is 7. Life is 5 years. Cash flows are given. Calculate NPV based on risk-free rate. Year, cash flow given in the question. PVF at 7% DCF, that is NPV at risk-free rate. Then NPV at RADR. What is the RADR? Is 7 plus 7. RADR is 7 plus 7. Risk-free rate is 7%. Extra risk premium is 7%. So 7 plus 7, 14%. No calculation, nothing needs to be done. Okay. Year, cash flow, PVF at 7%, DCF. Year, cash flow, PVF at 14% and DCF. Then KP Limited is investing rupees 50 lakhs in a project. Life of the project is 4 years. Risk-free rate is 6%. Sales of first year, second year, third year, fourth year, PVR, fixed cost. Ignore interest and taxes. Moment you ignore tax, depreciation will also be ignored. Moment you ignore tax, depreciation will also be ignored. You are required to calculate NPV based on what? RADR approach. What is the risk adjusted discount rate in this? First tell me. 6 plus 6, 12%. Can you tell me what is the cash flow for first year alone? Sales is there, PVR is there, and fixed cost is there. First year cash flow alone. 50 lakh into 50% is the contribution minus the fixed cost. PVR is the contribution minus the fixed cost. No depreciation, no tax, nothing is there. So again, a very simple question. Cash flows are given. You need to do a 12%. Then comes this question where I will only discuss what is the RADR you want to employ. What is the RADR? Calculation of NPV, I don't want to do it because year cash flow is directly given. Year cash flow is directly given. So ABC is evaluating 3 projects P1, P2 and P3. Following data is available. Cost, initial outflow, inflow of first year, second year, third year, fourth year. Risk index is given. Risk index is given. I've discussed this in an MCQ. Let's start. RADR of project 1 is equal to, right, RADR of project 1 is equal to RF plus risk index into normal rate minus risk free rate. Normal rate minus risk free rate. It's nothing but RF plus beta into RM minus RF. RF plus beta into RM minus RF. What is the RF given in the question? Risk index 1.8 into normal rate RF. So first project do at 19%. First project at 19%. Quickly do project 2 and project 3. Do project 2 and project 3. $19, $15 and 13%. $19, $15 and 13%. Again, I don't have much to add on because cash flows are given. Again, if cash flows are not given, then you will have to follow your basics and do the proper calculation. Any doubts on this? Zero utility. Zero utility. Reason is I'm assuming this inflow is after tax. I'm assuming this inflow is after tax. If you assume this inflow is before tax, then less depreciation, PBT, less tax, PAT, add back depreciation, CFAT. Why? Cost is there, no? 15. 4 years. Where is the number? Year 1, year 2, year 3, year 4. 15 lakh divided by 4. I don't know. I have followed what ICA solution is, but okay, you are right. If you want to do it that way, you do it. Start doing the cash flow calculation. You are perfectly right. I have no answer to that. Okay, let's come to 48. Particulars and 3 projects. Net cash outlay, project life, annual cash inflow, coefficient of variation. Company selects RADR on the basis of CV. Project X, what discount rate should I use? Project X is 16%, 3.274 will be the annuity factor. Project Y 14, Project Z 12. Very simple. I don't have anything to do here. Okay, what they can make it little complicated if they want, instead of giving the coefficient of variation directly, they can say standard deviation is so much and annual cash inflow is so much, so that you first calculate the coefficient of variation as standard deviation divided by annual cash inflow, and then you start doing the problem, then you start doing the question. Now comes the CEF approach. In CEF approach, we'll do one question. What we do is we adjust the cash flow. We adjust the cash flow. Now write year uncertain cash flow, CEF certain cash flow. Year uncertain cash flow, CF, certain cash flow, PVF, DCF. Cash flow basically has three columns: uncertain, certainty equivalent factor, and certain. Year, uncertain cash flow, certainty equivalent factor, certain cash flow, PVF and DCF. Year 0 you can directly write it in CC. I need to finally discount CCF. I need to finally discount CCF. Year 0 there is no uncertainty element. Uncertain element is only for future. Year, uncertain cash flow, certainty equivalent factor, certain cash flow, PVF, DCF. Tell me. Coefficient of variation at two formula. One, we have done in few question with cash flow, no? Standard deviation of cash flow, annual cash flow. First year, what is the outflow given in the question? Year 0, sorry. Year 0, 3 lakh, directly write. Year 0, 3 lakh, write directly. Year 0, 3 lakh, directly. First year, how much? What is the certainty equivalent factor? So 1 lakh into 0.9 is what we will write. Second year, into 0.8. 120. Third year, into 0.6. As time passes by, the CF will keep going down because my confidence level goes down. Fourth year, 0.55. Fifth year, uncertain cash flow. That is uncertain. Any certain cash flow, the balance should. I didn't understand. The total is uncertain. In that, part of it is certain. You cannot say part of it is certain and part of it is uncertain. As such, the overall number is uncertain. In that, with 90% confidence, I am giving the certain number. PVF at what rate? What is the risk-free rate? Now listen, normally you'll have to follow only risk-free rate, but question tells you to follow some other rate, please end up following. Why risk-free rate? Because I've removed the risk from the cash flow and got it to a lower number. So I cannot double penalize now. PVF at 7%. PVF at 7% and DCF. Conclusion all remain NPV positive, go ahead, NPV negative, reject it. This is one way of adjusting the risk in the project. So what we do in the advanced part is one way of measuring the risk is standard deviation. One way of adjusting the risk is RADR approach. Another way of adjusting the risk is CF approach. Each has its own way of doing. CF and RADR are opposite to each other. RADR adjusts the discount rate. CF adjusts the cash flow. CF is a very good approach. The problem is this. This has a lot of subjective element. This has a lot of subjective element. So that is why RADR is more popular. RADR is popular because it's easy to adjust the discount rate rather than adjusting the cash flow. It's the same question. Tell me, looking at the two CFs, which is more risky and which is less risky? Which is more risky? So X is more riskier. So in exam they asked if RADR is used, which project should be appraised with the higher rate? Some students thought I will calculate this and based on this I'll say which is more risky, which is less risky. Nothing to do with the NPV. Nothing to do with your NPV under CF approach. So to answer this, what you need to do is add all the three. Sometimes some can be higher, some can be lower. Here it is okay. Add all the three. Total of these three is how much? 2, 2.4. So CF, cumulative CF of project Y is more than cumulative CF of project X, which means Y is more certain, less risky, less RADR. X is less certain, more risky, more RADR. Clear? Any doubts on this? What can happen is you saw 0.8, 0.9. Suddenly this can be 0.8 and this can be 0.7. One is higher, one is lower also. 1 year higher, 1 year lower. So to avoid all this, you just need to put a total. You just need to put a total, something like this. Cumulative CF is 2 and 2.4 and accordingly give a commentary. Any doubts on the RADR versus CF approach? Very simple. We took only 15 minutes to discuss it. So many questions were also there. Extremely simple area. Extremely simple area. Can we proceed? Now move to the next area, which is called sensitivity analysis and scenario analysis. Scenario analysis is a very simple part of it. You don't have much problem. Sensitivity analysis is a very lengthy kind of a discussion. Practical scenario is more difficult. Sensitivity is easy. Now let me first explain. I calculated the NPV of the project. NPV is dependent on various parameters. It is dependent on cost of the project. If cost of the project increases, I can have trouble. If selling price reduces, I can have trouble. If unit sold reduces, only adverse thing, okay, no positive thing. We are only thinking about adverse changes. We are only thinking about adverse changes. If one change happen at a time, it is called sensitivity analysis. If multiple changes happen at a time, that is called scenario analysis. For example, recalculate the NPV if initial outflow increased by 20%. That is sensitivity analysis. Recalculate the NPV. Practically, I have done both sensitivity and scenario for my clients. Recalculate the profits or NPV if revenue decreased by 5%, variable cost increased by 10%, fixed cost increased by 5%, initial outlay increased by 20%, life of the project goes down by 1 year. Some scenario like this, that is called scenario analysis. Now, scenario analysis is not much in your syllabus, very simple kind of a discussion. In sensitivity analysis, I want to know my project is most sensitive to which factor. What is most sensitive is success or failure of my project is, for example, success or failure of your CA exam is dependent on maybe one subject. That is the most sensitive subject for you. That's the most sensitive subject for you, because if you do well in that subject, you will surely clear. If you do bad in that subject, you may not clear. So something like that for a corporate, if my initial outlay I estimated originally, if it turns out to be the same, I will succeed in the project. Others are not a problem. The initial outflow is the problem. Or selling price is the problem. I decided selling price will be 20. If it turns out to be 20, okay. But if it turns out to be 19 or 18, I will fail. 19 or 18, I will fail. So two ways of measuring sensitivity, or two ways of identifying which is the most sensitive factor. First approach is assume a uniform variation in all the parameter and see how much is the NPV going up or going down. See how much is the NPV going up or going down. So, sir, not going up, going down. NPV will only go down because we are assuming only adverse variation. We are assuming only adverse variation. So, what I did is selling price, cost, variable cost, fixed cost, and initial outflow. I change each of them by 5%. When I change selling price by 5%, my NPV went down by 40%. When I increased variable cost by 5%, my NPV went down by 20%. When I increased fixed cost by 5%, my NPV went down by 80%. And when I changed my initial outlay by 5%, my NPV changed by 10%. This is the most problematic for me. Because if fixed cost changes only by 5%, NPV will change by 80%. So I need to have a lot of control on fixed cost. Before I do the project, I ask the MD is asking CFO, are we sure about fixed cost? Will anything go wrong in fixed cost? If anything goes wrong in fixed cost, our project will fail. Or the CFO would be asking the MD saying that this is the most sensitive factor. I don't want any deviation in this. If a deviation happens, be ready, the project will fail. This is one. Second, MD is asking, you don't tell me the impact on NPV. Tell me how much cushion do I have in each of the factor. What is cushion is selling price can change maximum by 15%. If it changes by 15%, NPV will become zero. If it changes by 15%, NPV will become zero. So I have a cushion of 15% in selling price. Variable cost, I have a cushion of 12%. Fixed cost, I have a cushion of only 5%. In initial outlay, I have a cushion of 20%. Some cushion calculation I'm doing. So if you are following approach 1, you need to find which has maximum fall in NPV. Approach 2, which has the lowest cushion, which has the lowest cushion. If you have lowest cushion, that's a problem. That's a problem. Both approaches can be done. Sometimes ICA will say approach 1, sometimes they'll say approach 2. That is, approach 1 is easy to do. That is, change the factor and find the impact on NPV. Approach 2 is you need to find when will it result in zero NPV. Some reverse working you have to do and find. I'll ask at what selling price will we have zero NPV. At what cost price will we have zero NPV? At what initial outlay will we have zero NPV? So you need to answer me at when I'm going to have zero NPV. Two approaches: uniform change in input variable. Consider uniform adverse change in input every variable and compute the impact on NPV. Variable with maximum impact on NPV is the most sensitive factor. Percentage changes, okay, fall in NPV by old NPV. Identify the value of input variable at which NPV will be 0. Parameter with the lowest sensitivity. This is not sensitive, lowest cushion percentage. Parameter with the lowest cushion percentage is the most sensitive factor. Example we have: project cost is 12,000, annual cash flow is 4,500, cost of capital is 14%, life is equal to 4 years, PVIFA is 14%, 2.9137. First, can you tell me the NPV of this project? Quickly tell me the NPV of the project. Triple one point. So 13,111.65 minus 12,000. If my initial outflow from 12,000 increased to 13,111, my initial outlay from 12,000 to the project cost, they want the measure of the sensitivity for project cost. If project cost from 12,000 increased to 13,111, we will have zero NPV. We will have zero NPV. So project has a cushion of 13,111.65 minus the original project cost 12,000 divided by 12,000. That is, project can absorb 9.27% increase, 9.27% increase in the initial outlay. In the initial outlay, this is for the project cost. Like this, you can do it for any parameter. Now, next example: identify the factor which is having maximum sensitivity to the project. Base NPV 200. If you do 10% increase in selling price, if you do 10% increase in or decrease in selling price, NPV becomes how much? Which is a 25% fall. From original 200, it is a 25% fall. Second parameter, it is a 10% fall. Third parameter, it is a 50% fall. Fourth parameter, it is a 20% fall. Which is leading to maximum fall? Variation in life. So life is the most sensitive factor here. Life is the most sensitive factor. Next, a project currently has NPV of 25 lakh. However, the project is sensitive to multiple factor with a significant variation can cause reversal of investment decision. Reversal of investment decision means from positive NPV you will get to negative. Indirectly, this is the cushion available. Selling price, you have 25% cushion. If you have a 25% variation, no problem. More than 25, you will get into negative. You will get into negative. Which has the lowest cushion percentage? Fixed cost. So fixed cost is the lowest cushion. Fixed cost is the lowest. See, in approach 2, you find the lowest cushion percentage. In approach 1, you find the maximum impact on NPV. Maximum impact on NPV. Clear? Any doubts on this? Let's start now. Go through 51. Okay. They've asked us to calculate the NPV Does it represent the actual outcome? No, this is my expectation. Then they're saying what is the impact on NPV if there is a 2.5% adverse variance in each variable. Adverse means the negative change. So I'll first do the initial NPV and then we'll give effective changes. What are the changes? Units initial outlay can increase, unit sales can go down, selling price can go down, variable cost can go up, fixed cost can go up, discount rate can increase. Life will not be able to do, life will not be able to do because I cannot calculate for 3.4 minus 2.5%. Life, if you want to do, you will have to do only through approach 2. What happens, I'll explain later. Let's do working note 1 base NPV. Working note 1 base NPV. Particulars, amount. All rework I'll only take you through, only the original let's do it. Particulars, amount, initial outflow. Initial outflow. How much is the initial outflow? 400. Number of units sold. Number of units sold. Number of units, 5 crore. So I'm doing 1 year calculation. I'll do into 4 later on. Annuity, we'll use the annuity factor. Selling price, sales. Why I'm writing separately so that I can do the sensitivity later. 500. Variable cost, 5 into 50. 5 into 50, 250. Fixed cost, 100. Okay, 200. Take it. CF80, 200. CF80 is 200. PVAF, annuity factor, 4 years, 6%. Present value of inflow and NPV. 4 years annuity factor. 3.465. 200 into 3.465 and my NPV 693 minus 400. Beyond this, you'll only be in listen mode, okay? Original NPV once you calculate, beyond that, your job is very limited. You need not keep doing the calculation. It'll obviously take away a lot of time also. Any doubts on this? Was the first change? I'll make this as 410, extra 10 per extra 2.5%. NPV falls by 283 minus original 293 divided by original 293. 3% fall is there. There's an NPV of 3% fall. What is the second sensitivity they've asked us to do? One by one, you see. Unit sales. Unit sales. So from 5 crores, I bring it to 4 point. NPV falls by 7.39%. NPV falls by 7.39%. Again, I bring the original data. The next one. So I leave the 5 as it is. I do 97.5. I do 97.5. NPV falls by 14%. NPV falls by 14%. So you'll have to keep doing this, but it will unnecessarily take away a lot of time now. What's the next factor? Variable cost. Original data I've taken. I increase variable cost from 50 rupees to 51.25. 51.25. 7%. 7% is the change. What's the next one? Original 50 I leave it. Now I change it to 51.1.48%. 1.48%. What's the next factor? Discount rate. Discount rate is original figure. Originally, what was the discount rate? 6 plus 2.5% do in calculator. So give me a 4-year annuity factor for 6.15. 6 plus 2.5 is not 8.5, okay? 6 plus 2.5 is not 8.5. If you do it that way, that is a 40% change. 6 3.45. So this has an impact of 0.82%. So lowest impact is on discount rate, highest impact is on selling price. So I should be doubly triply sure about selling price. I should be doubly or triply sure about selling price, because if selling price changes, my project may get reversed. My project may get reversed. Clear? Any doubts on this? This is one way of doing sensitivity analysis, where you keep assuming an uniform change. And we are only doing the adverse change, no positive change. We will not be considering any positive change, only adverse changes are considered in the calculation. 52 is something you try at home, where they are saying 10% change, 10% change in each of the parameter. Go through 53. Go through 53. Okay, here they are again asking us to measure sensitivity, but what they are saying is NPV should become 0. NPV should become 0, taking three parameter: cost of plant, running cost, and savings. My NPV calculation is going to be slightly different. I'm not going to do year cash flow PV of DCF. I'm going to do it slightly differently. Base remains the same. The base calculation remains the same, but the approach is slightly different. The approach is slightly different. Working note 1: computation of NPV. Computation of NPV. Particulars calculation amount. Particulars calculation amount. Point number 1: cost of plant. Cost of plant negative 12 crores. Writing it in lakhs, okay? Negative 1200. Negative 1200. Negative 1200. Point number 2: running cost 400 into first year factor 0.89 plus 500 into second year factor 79. Instead of doing discounting together, I'm doing separate discounting of each item, plus 600 into third year factor 7 1, 3 decimals, so 712, then 712. So 1 divided by 1.12, first one itself is, sorry, is 893. Please do 3 decimal 893. Second one is 797. Third one is 712. See, what you normally do is you do year cash flow PVF, DCF, where you net off the running cost and the savings. I want you to do separately. Reason for doing separately, I'll explain. So 400 into 0.893, 500 into 0.797, 600 into 0.712. Third one is savings. The savings in the first year. 1200 into 0.893. 1200 into 0.893. Second year 0.797. Third year 1100 into 0.712. The total of these three is NPV. The total of these three is NPV. Why I am not doing in normal manner, you will understand in some time. total of these three is NPV. If you do year cash flow, PVF, DCF, same NPV you will get. Same NPV you will get. $587.70 lakhs. Now, why I've done the separate analysis? Very simple. My NPV will become zero if cost of plant increase by 587.7. Cost of plant increase by 587.7, or if running cost increase by 587.7, or if savings decrease by 587.7. Formula for sensitivity is change by base. So change is 587, base is these three numbers. I have base directly here. I have base directly here. Denominator is the cost of plant, that is from 1200. If it increased by 587, project is rejected. From 1182, if running cost increased by 587, project is rejected. And if savings from 2970 go down by 587, project is rejected. Sensitivity formula is change by base into 100. Assuming you had calculated single NPV, not doing all this, then you have to separately calculate all this. You have to separately calculate all this. What the sensitivity is? From 1200, if there is a 49% increase, project will get rejected. From 1182, if there is a 50% increase, project will get rejected. And from 2970, if there is a 20% fall, project will get rejected. This is the cushion available. This is the cushion available. Which has the lowest cushion? Savings. So this is the most sensitive factor. Savings is the most sensitive factor. Formula for sensitivity is change by base into 100. Change is 587.7. I have no problem. Then only it will become 0. But base, for project cost, I have the base. But for the others, I would need the base. So if you do, this is how I have presented in my class. I have separately shown all the three. We normally club them together and write it as one single cash flow. We club them together. What you do is you will normally add this together. You will normally add this together. I didn't want that addition to happen. I didn't want that addition to happen. I wanted it to be done separately. I wanted it to be done separately. Reason for doing separately is to use this in the base. 12 crore, 11 crore, 81 lakh, 90,000 and 29 lakh. Some up and down rounding of differences there. I think I've taken a wrong sense PVF in the printed solution. Let's not worry about this. Maximum sensitivity is to which parameter here? Savings. Clear? Able to understand this? Same question, if they tell 10% change, then you do normal NPV once and then give effective 10% change and then do recalculate. So depending on the requirement of the question, we will have to do it. The approach to, that is making zero NPV, looked very simple in this question, but few questions this is a very complex calculation. It's not a very easy calculation. So few questions approach 2 will be faster to do like this, but many questions only approach 1 is faster. Approach 1 is faster because I know what I need to do and I'll do. Approach 2 is reverse working. Approach 1 is normal working. Approach 1 is the normal working. Any doubts on this? Question will tell which approach to follow. Okay, question will indicate. Go through this question. Correct. That only I am saying now. Where did I say the opposite? Who told you to check the percentage that way? What does this mean? 20% change in savings will reduce NPV by 100%. 20% change in savings will reduce NPV by 100%. That's why I use the word cushion, because there's a doubt which many students have kept on asking me. 50% change in this will reduce NPV by 100%. So 1% if you change, only 2% is the impact on NPV. And 1% you change here, 5% is the impact on NPV. 5% is the impact on NPV. In approach 1, I find the impact on NPV. In approach 2, I find the cushion percentage of the base factor. Cushion percentage of the base factor. Go through 54. Has the question told about any adverse variation to be taken 5%, 2%? No, we'll have to bring zero NPV. We'll have to get to zero NPV where they've asked for what? Selling price, unit cost, sales value, initial outlay, and the last trickiest part is project lifetime. Project lifetime means you have to calculate discounted payback. What is discounted payback? Is the payback, the life at which NPV is zero. Discounted payback represents the life at which NPV is zero. Discounted payback represents the life at which NPV is zero. Clear? Any doubts on this? Let's start. Working note 1, computation of NPV. Computation of NPV. Initial outflow. Initial outflow negative 10 lakhs. Present value of sales separately, present value of cost separately. Sales separately, cost separately. I'll do separate analysis. Sales I'll do separately, cost I'll do separately. First year, how many units? 20,000 into 60 into first year factor 0.909. Second year, how many units? 30,000 into 60 into 0.826. Third year, how many units? Into 60 into 751. NPV is 309,800. NPV is 309,800. There are a lot of tricky adjustments here. NPV is 309,800. Any doubts on the NPV number? Any doubts on the NPV number? Can you proceed? What are the first sensitivity they asked on? Sales price is 309,800 divided by 39,29,400. If 39,29,400 go down by 309,800, project will get rejected. If 39,29,400 go down by 309,800, project will get rejected. What is the percentage? 7 point. This can also tell you break even selling price. Some question can ask, what was the original selling price? 60 minus 7.88%. 55 point. ICI has this answer 55.27. Okay, they will say at 55.27 you will get zero NPV. What's the second factor? 309,800 divided by 26,19,600. Divide by 26,19,600. 11.83%. 11.83%. Coming. What's the third factor? Sales value. If sales value goes down, along with that unit cost will also go down. Value means units. Value is basically units. If volume is going down, along with that cost will also go down. So the base is 309800 divided by 3929 400 minus 2619 600. Denominator is combination of both. Why combination of both? Reason is, when, for example, what is sales value is 20,000 becoming 10,000. So good part is, if 20,000 become 10,000, my sales went down. Along with that, cost will also go down. So the benefit for me is, when selling price reduces, no, I have a problem, because selling price directly NPV will go down. But when sales volume go down, NPV will not directly go down. Along with that, cost will also go down. So indirectly my denominator is my profit. I want profit to go down by 309,800. What is the profit today? 13,09,800. Profit today is sales minus cost. I want the profit to go down by 309,800. Clear? Any doubts in this? What's the fourth one? 10 lakh. Last one, if you have to do, you need to do year cash flow. Every year separately cash flow you have to do, and calculate discounted payback. I'm not doing the discounted payback part. I have done it in a different way. The solution, net the answer is going to be same: 7.88%, 11.83%. Any decrease in sales will also result in decrease in cost. So denominator is the minus 23.65%, 30.98, and for this you have to do discounted payback, which is 22.93%, which has ended up becoming 22.93%. Discounted payback is to be calculated. Any doubts on this? Part? Clear? Go through 55. Reverse working, good problem. No. Sensitivity normally means the okay, question. Yeah, correct. Sorry. Okay, let me discuss this question. We'll do it together. Question says IRR is 16%, life is 5 years. Financial manager has studied the sensitivity analysis and says fixed cost as a question of 7.8416%, cost of capital, that is the discount rate, as a question of 60%. IRR is the rate of return at which NPV is 0. Cost of capital as a question of 60%. When you read them together, what is the conclusion you can make? There's a conclusion you can make reading this together. IRR is the rate of return at which NPV is 0, and cost of capital has a cushion of 60% means what? Now let's not get into the fixed cost part. I'll come to fixed cost later. What is the understanding with IRR of 16 and cost of capital sensitivity of 60%? What do you understand out of it? If the cost of capital increases by 60%, NPV will become 0, which means IRR is equal to 160% of my cost of capital. IRR is equal to 160% of my cost of capital, because if cost of capital increase by 60%, NPV is going to become 0. So write IRR equal to 1.6 KO. IRR equal to 1.6 KO, 160%. 160% is 1.6 times. Why 1.6? 60% sensitivity is built in. 60% sensitivity is built in. 16 equal to 1.6 KO. KO is how much? What is the use of this? We'll see it later. 10% is the cost of capital. Okay. Now I know my annual cash flow is this much. I know my annual cash flow is this much, which is 57,500, which is 57,500. I can do calculation first at 16%. I can do calculation first at 16%. When I do calculation at 16%, my initial investment will come. And then I'll repeat calculation at 10%. I'll repeat calculation at 10%, which will give me NPV, which will give me NPV. First I'll do it 16%. Next, computation of initial investment. Computation of initial investment. IRR is the rate of return at which NPV is 0. Here, cash flow, PVF at 16%, DCF. NPV will be 0. Year 0, how many years is the life? 1 to 5. Question mark 57,500. Take the factor from the below table. Don't take it whatever 2 decimal 3, whatever they have given. 3.274 DCF 188 255 question mark. This is 1. Total is 0. Total is 0. Why total is 0? Because IRR is the rate of return at which NPV of the project is 0. What is the question mark? Minus 188 255, which means this number is 188 55. This number is also 188 255. Any doubts on this? Any doubts on this part? Can we proceed? So initial investment is 188 255. I will repeat this table now at 10%. Repeat this table at 10%. Repeat this table at 10%. Repeat this table at 10%. $3.79. So my NPV is 29,728. Any doubts till this? Okay, we have now reached almost 2 requirements are done. Third requirement is to find fixed cost and unit sold. Unit sold is more of a cost accounting adjustment, but they've asked for fixed cost and estimated annual unit sales and break even units. Break even is fixed cost by contribution per unit. Now coming to annual fixed cost, they have given sensitivity of the fixed cost is how much? Okay, now tell me, if fixed cost increase by 1 rupee, will my profit go down by 1 rupee? Why? Why no? Yes, sir. It will increase by only 1 rupee. If fixed cost increase by 1 rupee, will my profit go down by 1 rupee? Clear? Any doubts in this? So my today NPV is at 29,728. Listen, 7.8416 percentage of fixed cost, 7.8416 percentage of fixed cost into 3.791 years, into 3.791, not years, annuity factor, into 3.79, that is first year fixed cost. I don't know the number, it changed by 7.8416 percentage. Second year again it changed, third year again it changed, fourth year again it changed, fifth year again it changed, into 3.791 is equal to the NPV I am generating, is equal to the NPV I am generating. Listen, I'll explain again. If my fixed cost present value increased by 29,728, my NPV will become 0. My NPV will become 0 because NPV today is 29,728. NPV today is 29,728. First year change, fixed cost into 7.8416 percentage. Second year same, third year same, fourth year same, fifth year same. Into what you need to do? Into the annuity factor, because every year it is happening. Tell me, what do you get as FC? Sorry, 1 lakh. 1 lakh is the number I get. 1 lakh is the number. 29,728 divided by 3.791 divided by 7.8416 percentage. It goes to the other side. Calculation part you will have to take care. 4 and 5 you can manage it. Same answer you will get, whichever formula you do. Okay, for your satisfaction, I'll do change by base is equal to 7.8416. Okay, if you write percentage, you should do, sorry, into 100. Okay, into 100, 7.8416. My base is fixed cost into 3.791 base, because every year we are taking present value. What have we done? See here, did I not add 5 years data? Did I not add 3? Did I not add 3 years data there? Change is 29,728 equal to 7.8416. You can check the answer. Any doubts on this? Change by base you do, or any approach you do, you'll get the same answer. In fact, here I think I would have done that only. Change by base is what is done. Annual increase in fixed cost divided by 3.791%, 7841.6. Annual fixed cost is 1 lakh. Beyond that is formal. 56 you attempted, it's a good question. 57 is on scenario analysis. Again, I'm not discussing 56, 57 and 58. They are question on sensitivity. 56 is a slightly tricky question. Do attempt it at home. Scenario is very simple. 57 and 58 is going to be very simple. I wanted to in fact complete capital budgeting today. I'm also lost the energy fully now. So I'm ending at this stage. I'm not even revising capital budgeting now. I'll revise your capital budgeting in tomorrow's session. First, we will complete only, I think 2 areas are pending. We'll take around 1 hour of discussion, which is decision tree and simulation. That discussion I will complete. Once I complete that discussion, I may revise it fully, and then I move to security valuation. We'll be moving to security valuation tomorrow. Based on what ICI does, if they change your exam dates, I may take a break, 1 full day break in between. I may, again I'm repeating. Reason is, if I depending on what doctor says today, I'll tell you what is the approach. Mostly exams will get postponed. So in case it gets postponed, I do get a flexibility of 1 day in between. Okay, check it.